Oh my goodness. I'm so happy that you're here in our final presentation on options because this material might actually come in handy someday, depending on where you wind up in the benevolent machine workaday world. We're going to discuss employee stock options, a few odds and ends, and then some final comments on options. ESOs, as they're often referred to, employee stock options, are options granted to an employee by a company, giving the employee the right to buy shares of stock in the company at a fixed price for a fixed time. Now, so they're options, they're call options, they're always call options, and they usually have significant differences from normal call options. First of all, you can't sell them, they're only for you. They take many years to expire 7, 8, 9, 10 years. And they usually have a vesting period 3, 4, 5, up to 7 years. And if you leave before the vesting period is over, well, you lose your stock options. So these were used and still are used by companies that are starting out that really don't have enough to pay you very good salary. So they sweeten the deal by saying, look, you could own a piece of the company. And if the company's just starting out and becomes really successful, you can become very, very wealthy. Uh-huh. Doesn't always work out that way, but sometimes it does. Yes, it does. So let us continue on slide number 44. During the 2000 to 2002 bear market, when the .com explosion became the .bomb implosion, employee stock options were the subject of much controversy, and there's still some fallout on publicity as companies and the Securities and Exchange Commission continue to wrangle over how and when, even if they should be used. Currently, companies can give employee stock options to their employees and not have to pay anything. They don't have to reduce their company's earnings. But many companies have agreed to expense stock options. But how do you come up with a price for something that is currently not worth anything? You understand? In other words, these things aren't worth anything right now. They might be worth something later on in the future. They might be worth a whole lot. But right now, they're not worth anything. So, how do you put a price on them? To make matters worse, some people became fabulously wealthy when their employee stock options bore fruit during the internet mania. You might have remembered the gentleman who owned the Padres for some time, John Moores, and Peregrine, which was a local company that soared and during the .com explosion and then crashed and burned. Many others, though, were socked with crippling tax burdens on worthless pieces of paper when their companies collapsed. How can that be? Well, the alternative minimum tax doesn't care whether or not you ever got to exercise those options. You still owe tax on the paper gain, even if you were never able to realize the gain. This was bizarre. And some people were, literally destroyed. They were hit with tens of thousands of dollars in taxes on stock options that weren't worth anything. And the IRS did their best to help them, but they said, "Look, it's the law. Go talk to the Congress." So it's insane. But you could become very, very wealthy if your company did well. Yes, and some people did. Some people. Oops, again, I didn't mean to do that. So wait a minute. Wait a minute. Did you ask how do you come up with a price for something that's currently worthless? Yes, that's correct. Most ESOs, employee stock options, are out of the money, often by a large amount. And you cannot exercise them for a long time, or both. So, how do you put a price on it? Well, there's a system that is called the Black-Scholes option pricing model. And it sounds impressive, but in my humble opinion, it's very silly. And they should devote a whole chapter to it, but we're going to ignore it if you don't mind. I hope you don't mind. But this system was the basis of the option pricing that was done throughout the 80s and 90s and is a big part of the long-term capital management debacle in 1998 when genius fails. And it's also called the $1 trillion bet. I think it was called in Frontline. So it's out there. If it's now it's ancient history, right? But it was a bit of a disaster. Literally, some people made a lot of money. Others lost a whole lot, and it almost brought down the system in 1998. And it looked like a prequel to the global financial crisis of 2008 and 9. So, example, the Black-Scholes pricing model might say, okay, we got a stock currently selling for $7.50. The employee stock option has an exercise price of $10, so it's currently out of the market. Plus, the employee cannot exercise the option for 3 years. So the Black-Scholes model might say, well, the employee stock option is worth $2.50. Huh? You can't sell it? You can't exercise it for 3 years? It's out of the money? How is it worth $2.50? The stock price might never go over $10, and if you're unfortunate enough to be affected by the AMT, you might have to pay taxes on it. Thank you very much, but no thank you. Now, there are now stock index options. So instead of just simply doing call options or put options on individual stocks, you can do them on the S&P 500 or the NASDAQ or the Russell 2000. A stock index option allows an investor to purchase or sell an option that responds to the stock market index. So you can hedge an entire portfolio by purchasing a put on the stock index option that represents that portfolio. So it's insurance, a protective put against a large loss. So say you have stocks that look like the S&P 500, large company, mostly based in the United States. You could buy a protective put stock index option. So if the price of the stocks go down, the S&P 500 is going to go down. You could turn around and exercise that option. Insurance is not free. There are 75 indices or more, probably more by now, represented, including large, mid-cap, small-cap, domestic, international, regional, country-specific. Whether speculating or hedging, it's still risky and it's still expensive. And then there are options on interest rates and currencies. Now, these can actually be an important tool that we will discuss in more detail in our next presentation when we take a look at futures. But for the vast majority of us, no, it's still gambling. And then my understanding, I don't concern myself enough with these things to really learn why leaps are any different than any other options. But supposedly options expire before a year, 3, 6, 9 months. But these leaps, long-term equity anticipation securities, they came up with the name leap before they found out what it was going to mean, can be 3 years. Now, how do they get away with it? I don't know. They made some deal with the Securities and Exchange Commission, but still, it's gambling. So if you are so inclined, have at it, dear students. Here is something that you may come across sometimes, probably not. Warrants. Warrants are options, long-lived, that give the holder the right to buy a stock in a company at a price specified on the warrant. Now, they're issued usually by the same company that issued the stock, and they're often accompanying the bonds or the stocks to sweeten the deal. Hey, buy our bonds or buy our stocks and we'll give you some warrants. And it might be given to employees as compensation, like employee stock options. But unlike options where each contract represents 100 shares of stock, one warrant represents the right to buy 1 share of stock. And warrants are always call options. It's an option to buy. There are no put op warrants. And these warrants can sell just like options can sell. So you don't have to wait for the warrant to be ready to be exercised. You can turn around and sell it. So it's yet another way to sweeten the deal for people buying the stock or the bond or working for the company but it's not likely that you will come across these things. What are our final comments on options? Well, dear students, stay away from them. Just stay away. I mean, the possibilities are endless, so are the losses and the commissions. But wait. There are people out there who are ready to tell you and show you and educate you in how you can become rich beyond your wildest dreams by buying and selling in options, making 100% a day and then losing it the next day. And so here are some of them, folks. Just some of them. Online Trading Academy, 5 days, 30 hours, only $5,500. That's only $183.33 per hour. What a deal! You spend more in 1 hour than you did for this entire 3-unit class. It must obviously be worth it. And these people, well, this one's only $2,997. They must need new traders. They must need new traders. And then Optionetics was one of those that was really just egregious. It's now owned by Tom's Trading Room. And so the world changes very quickly. Trade wins. These folks have got to be seen to believe. I just can't believe them. And then here's a buddy of mine who used to buy options, and I tried my best to stop him from doing it. And so he describes why he did it, but he doesn't do it anymore. And then there's some articles that you really do read these. There are dozens, folks. This is just a few examples where people just made horrible decisions. This trader believes he has no risk options positions and promptly loses 2,000% on the transaction. He believes he has no money at risk. A 20-year-old trader took his own life after racking up what he thought $700,000 debt selling options, but it wasn't. It just looked that way. It really wasn't that way, but he killed himself anyway. And then this gentleman, using another example of derivatives, not exactly, they're similar to options, but they weren't options, but they were even more dangerous. He built a $10 billion investment firm and it fell apart in days. And just recently, this mutual fund fell apart, literally fell apart over the last few days because they were using some kind of derivative. And I thought mutual funds are really not supposed to use derivatives, but they were not pricing the derivatives correctly. And so it looked like the fund was worth $1.7 billion, but it's actually not worth that much. So yeah, good luck. Stay away. And that's just a few of them that I've gathered. There are many others. So to review, stay away from options. And in our next chapter, our next presentation, we'll take a look at futures, which actually, believe it or not, do have a reason d'etre, or a reason for being, a useful purpose in our economy, but not for you and me. So again, that's another thing you want to stay away from. Thank you so much, dear students, for sticking out this chapter. Again, the questions are going to be given to you that are going to be in the final exam. There will be no calculations, even though there's a worksheet. It's just there to show you the kind of calculations you'll see on the securities exam, the Securities Industry Essentials exam, and then the Series 7. And they're tricky. They're absolutely tricky, but they're not impossible. You have to do them enough times and you'll get them. So see you in our next presentation when we take a look at the cousins of options contracts, and that is futures. They are futures contracts. Thank you so much for being in our class.